Boom! What's going on, Investomaniacs? Your boy Night Rider here, and today we've got a subscriber question from Annie, and she says, thoughts on Pinterest now that almost all states are open and advertisement will likely also go up. First of all, Annie, thank you so much for the question. By the way, if anybody else has a question, feel free to let me know whenever, and I'll try to get to it if I have time. So first of all, Annie, if your thesis for why you want to invest in the company is because, hey, states are reopening, therefore advertising spend will likely go up, which is a true statement. At least I agree with it anyway. What we want to do is look at where the stock is relative to where it was before the crash. So right now, the stock is at $20.51. Although the highs of the market were not February 21st, I use February 21st as the last day pre-corona crash. So that's just what I personally do. So we're right here on February 21st, and the stock closed at $22.48. So you're about, roughly speaking, 10% off of where you were before the corona-related crash. Now, you came all the way down and bottomed at $10.10 intraday, and you're now up at $20.51, so you've more than come 100%. The stock has more than doubled off of its lows, and you're now only about 10% off of where you were pre-corona. So I'd say if your logic, right, if the thesis is, hey, advertising is going to go back up to kind of where it was pre-crash, I think the stock has already recovered too much, and I would look for another advertising type company that is still more significantly off of its lows. Now what we're going to do is go ahead and look at 5 different stocks. They're all internet stocks. 4 of them are make their money through advertising, which is kind of what you're looking at in Pinterest. And I've blacked out the names of the companies so we can just focus on the financials, and hopefully that will give you a different perspective of what you may want to choose for your investment. So let's go ahead. All we're looking at is the PE ratio. These two down here are losing money, so that's why it's redded out. The operating margin in 2019 and the 1-year revenue growth percentage-wise going 2018 into 2019. They're all high growers. 3 of them make money, so let's go ahead and get started. Let's look at the 2 fastest growers because they're pretty darn close. We have 51.2% versus 51.9%, so almost the same, but this one's a little bit faster. This one has operating margins of negative 5.75%. That means for every $1 in revenue they bring in, they lose 6 cents. In contrast, this one has negative operating margins of negative 121%. That means for every $1 in revenue they bring in, they lose $1.21. So this one is losing roughly 20 times as much money as this one, and yet they're growing the top line at the same rate. So now, again, obviously in reality, you're going to look a little bit more into detail in the financials. I'm just trying to give a simplified explanation here. This one obviously is going to be in worse shape, losing 20 times as much money. So if we really want that power growth on the top line, we're going to opt for this one. Now let's go ahead and look at these 2 mid-range growers at 35.5% and 38.5%. Our 35% grower is operating margins of positive 11%, whilst our slightly quicker growing 38.5% has stronger operating margins at 17%. They're both decent. I'd consider them both kind of mid-range operating margins, but obviously this one, 17% is roughly 60%-ish stronger than 11%. So we're going to prefer this over this, provided the price is the same. So here we come to the PE ratios, and our slower grower with worse comparatively operating margins is 132 PE, whereas the faster growing, stronger operating margin company is 125 PE. So this one is actually a little bit cheaper. So between these two, this one is growing the top line quicker. It has stronger operating margins, and the PE is lower. It's cheaper. So again, obviously, between these two things, all other things being equal, we're really going to prefer this one over this one. And then kind of as a standalone, we have this one here at 26.7%, so a little bit slower growth relative to the other ones. However, look at these amazingly strong operating margins at 37.6%. That's a company that has a very strong dominance in its industry or field and likely doesn't have a lot of competition, or at least is strongly dominating that competition. That's usually the only way you can get to such strong operating margins. And it's actually not that expensive at only 33.5 PE. So that's only about 25% the cost of these two right here. But obviously, you are sacrificing some top line growth to get there. So I would look between these five and say, hey, which one do you prefer? If you really value top line growth above everything else, then this is probably the one you're going to be with. If you're a little bit more on the safety side, maybe you'd go with this one. And then if you're in between, maybe you would go with this one. Now let's go ahead and take a look at what the actual companies are. We have Facebook. This one makes sense. Very dominant in its space. Fantastic operating margins. But on the downside, it's one of the largest companies in the world, and we probably know it can only grow to be so large before it's just going to have a difficult time maintaining that 20% plus top line growth, at least relative to these much smaller companies. And then we have Etsy. I love Etsy, big believer in that platform. The Trade Desk, if you were looking for an advertising platform, hey, here's an online advertiser. I would definitely recommend the Trade Desk. I do love this company as well. And then here was yours at Pinterest. So unfortunately, I'd say from a financial standpoint, I wasn't a big fan of Pinterest, although I do like the platform. That's a lie. I've never really used the platform. And then there's Roku, which I'm also a big fan of and currently invested in, although I am considering actually getting out of that just because I think the stock has ran a little too much too quickly. And I really do love that top line growth and this minus 6% operating margins, although it's actually a little bit worse in the past couple quarters, nonetheless is an amount of negative operating margin I feel comfortable with. It doesn't go into an amount of negative operating margin that I don't feel comfortable with. So anyway, hey guys, that's my video for today. Hope you guys have a great one.